It's an important hour of the day after the lunch. I think everyone is fully energized from the amazing lunch that we had outside, so yeah. We start with the 13th session, the Hercules 13 task, the Greek NPL. Moderators Gerasimos Papaleventis, Head of Control and Monitoring Bank Treasury FIMBank, Chariton Papatriantafyllou, CFA Strategy and Investment Officer FIMBank, and the panelist Nicola Caro, Sector Lead European Financial Institutions, Ratings Morningstar, Vasilis Kosmas, Chief Financial Officer of FIMBank, and Apostolos Kazakos, General Manager Group Strategy Eurobank. Welcome in hot.
I would like to welcome and thank Mr. Nicola Caro, Sector Lead in European Financial Institution Ratings at DBRS Morningstar, Mr. Vasilis Kosmas, CFO at FIMBank, and Mr. Apostolos Kazakos, General Manager of Group Strategy at Eurobank, for being today here with us in the fruitful panel Hercules 13 Task Greek NPLs. We will discuss the non-performing loans formation in Greece and its effort to reduce them. The Greek government has introduced the third Hellenic Asset Protection Scheme, also known as Hercules, during 2024. Last year, my friend Ioannis Bimbas was the moderator of a panel discussing about interest rate and inflation, a case between Scylla and Charybdis, so you can correlate the Greek mythology each year with the Greek economy. Over the last decade, Greek banks have faced major challenges and risks due to their extremely high exposure to non-performing loans. This exposure was a combination of the Greek financial crisis, affecting borrowers, along with the lending policy from banks' side over these years. There are treasurers, financial analysts, and officers among us today that have been in the challenging position of managing the cash flows and solvency of distressed groups. This in turn makes the life of bank treasurers and bank CFOs even more interesting and challenging. This is not Mount Olympus. We can see how it was evolved, the NPLs during these last years in Greece, and the big shock coming from these corporate NPLs. So, allow me to start with Nicola. Nicola, how do NPLs affect borrowers' financial health and in turn, credit analysis?
First of all, good afternoon and thanks for having me here. So the NPL story is something that goes beyond risk per se, but the implications are always across the entire banking organization, from franchise to earnings and funding and capital. So indeed, the NPL analysis is part of our risk analysis, which is one of the 5 building blocks of our rating methodology. Now, when we look at NPLs, first of all, what we do is we look at the stock of gross NPLs and obviously the breakdown by retail and corporates. And then we do a little bit of deep dive and we look at the granularity of the portfolio and the concentration level, and therefore the sectoral exposure. Important is also the analysis of the provisioning and how banks are setting aside provisions against NPLs. And within this, we also look at the appraisal method and how banks are assessing collateral valuation. On top of this, we also look at the operating environment. And when I say operating environment, I'm not referring only to the economy or the status of the real estate, but we also look at the legal framework. And therefore, for example, insolvency laws, foreclosure procedures, and enforcement law. And clearly for high NPL banks, we also look at the strategy and the plan to reduce these NPLs. And this comes along, the analysis of the overall structure, risk management structure, risk appetite framework, and therefore the various credit policy and procedures. So one of the lessons from the previous crisis is that part of the NPL problem was due to weak credit standards or inadequate or inexistent early warning systems, lack of instrument from credit management, and also inadequate judicial system. Now, what I'm trying to say is that whether part of this NPL story was unavoidable due to the severe crisis that Greece has faced, equally true is that banks were not prepared to face these challenges. Now, going directly to the implication of this problem, what we know from evidence is that this is a big cause of financial losses and capital erosion for banks. This is clearly negative when it comes to financial stability and reputation. So it's typically associated to a lack of trust for investors, clients, depositors, and ultimately it's also negative for the supply credit chain, and so therefore lending to the real economy, household, corporate. Final point, from an operational standpoint, this is a big burden for the operations, and because it takes away time and resources for the origination of good business and new business and core business. And interesting enough, when we say management of NPLs, we typically refer to a no-core division of the bank, but during this time, working out management of NPLs was the primary activity of these banks, not just in Greece, but also in other Southern European countries.
Thank you, Nicola. Vasili, do you agree with Nicola? Do you see the same risks? We spoke about stability, trust, and secondly, over these years, what has been the impact of NPLs on the bank's key financial ratios, such as capital adequacy and profitability?
No, I agree, obviously agree. I mean, I'm not going to comment on the rating methodology, although it's very well known, it's established to everyone. Yeah, definitely. I mean, the key point, or at least my experience, the key thing I observed during this 10-year period in banks has to do with trust, and trust drives. I mean, we all need to remember that banks effectively are intermediaries. So what happens on the capital and the ratios is when you accumulate stock, everybody starts losing trust, and all sort of prudential people, call them investors, rating agencies, regulators, they tell you, oh, you know what, your NPLs are growing, you need to set more buffers aside, and more buffers aside, and more buffers aside. And all this obviously depletes capital. But to me, the main challenge is not that it's depleting the capital of the bank, it's two other things. One, which Nicola touched, both Nicola and I touched. One is trust. So people just don't trust you. People don't give you money, and if banks don't receive money from credit investors, depositors, and like, they cannot give money. Unfortunately, it's a one-to-one relationship. And secondly, banks by definition, by regulator, are not set up to manage this type of exposures. I mean, that was always the case, in my opinion. So, you have, on the right-hand side of the balance sheet, you have deposits. If you call depositors, they think it's a AAA exposure. And on the left-hand side, if you can't have AAA exposures, you need to have at least investment-grade exposures, BB plus exposures. Banks are set up with committees, with processes to do that. They're not set up to do a quick workout. So that's, and we'll touch upon it, to me, the main benefit of HAPS, not just all the financial engineering and the structuring, which was also good, but the fact that, again, a point that Nicola touched upon, you pick something which was always a non-core division of the bank, the workout, the NPL units. You create a new structure and you tell them, you know what, now that's your core. Now you do that. And then first 6 months is difficult, first 12 months are difficult. Now, at least the cases I've seen, it's up and running. I mean, they're collecting from cases I would never imagine banks were able to collect.
Thank you, Vasili. Apostole, given what the previous gentleman mentioned, NPL reduction was surely instrumental in the strategy of the banks. What has been the most effective strategy to reduce NPLs? How did the Hercules scheme help in that process?
So first of all, we should say that the stock of NPLs was huge back in the time of the crisis. So we had to use every way to reduce this increased stock. Shall I use this? Okay.
I think it's better now.
Which means that I think now they can hear me. So the first tool you had was to restructure loans of borrowers, and to some extent this is a preferred tool because you give a solution to the borrower, you cooperate with them, usually you give a haircut, and life goes on. So that was the first and the main tool that we had back then at the beginning of the financial crisis. Having said that, it couldn't be the only way, because if anything, it takes time. First of all, not every borrower can service the restructured debt, but it takes time. It's a lengthy process. Then we had, and we used, all banks, the straight sale of non-performing loan portfolios. But this is an expensive tool because, if anything, again, back those days, the investors that they had appetite in this kind of portfolios, the expectations that they had for returns was quite high. So it is an effective exercise in order to reduce your stock, but it's quite expensive. So Hercules was instrumental for the acceleration of the NPL reduction for the Greek banking system because it combined the fast divestment of the portfolios, i.e. the sharp reduction of the NPEs, but at the financial structure that it was beneficial for the banks because you could finance part of the portfolio that you sold. Because as we know how it works, practically you securitize the loan book, the NPEs, and how you fund this, of course, the equity investor has to find the equity piece, which is the most expensive, but under the guarantee, the bank also can offer some financing for the senior piece. So practically, you have the combination of both worlds, because in essence, you divest like a portfolio sale, but at the same time, at a cost that the banks could afford at that point in time. So I would say that we used all tools, and we use all tools, but Hercules was instrumental for the acceleration of the reduction of the NPEs in the Greek banking system.
Thank you, Apostole. So having Vasilis and Apostolos representing the two major banks in Greece, allow me a question to both of you. What impact do non-performing loans have on the market's perception of your bank? And how do you communicate your NPL strategy to investors and other stakeholders, such as rating agencies?
Should I start?
Yeah, go ahead.
Please.
I think Vasilis touched upon this because it's a matter of trust. You know, the asset quality of the bank is very important. Vasilis has already touched upon this. So we all know what was the market capitalization of the Greek banking system until the time that the NP ratio reached not the European average, because European average is quite low. We still have a long way to go, but levels that could be considered as acceptable. So it is super important because asset quality is linked 100% with the health of the bank. It's a prerequisite to have a healthy bank to reduce your troubled assets. And nowadays, of course, this is a legacy, but it is a good legacy from the past. We do communicate a lot about our asset quality. Actually, it was part of the monitoring of the regulator also. So you have to be very transparent and give all the necessary data to the community of investors in order how your NP stock goes. But even more important, once this is reduced, how the early buckets are doing, how the formation is doing, because maybe the NP issue is done, more or less, but we have to be very careful in order not to create a new problem again in the future. So you have to be very transparent and very careful in the info that you give to the public domain.
I agree with Apostolos. I think what I think is we currently have a situation that there's not much of a discussion about NPLs, especially in the case of Eurobank. And that's great. Hopefully, we're going to be there in the next couple of quarters. as Alpha Bank, and then people start focusing on something that Nicola mentioned, all the early warnings, all the drivers that could get you in a high-risk situation in the future. So stage 2 loans, forbearances. What type of forbearance are you doing? Are you doing step-up? So people are diving into the performing the healthy book and say, okay, does this book has any sort of characteristics that one could think that could, not in the same situation, but could trigger similar situations in the future. That's the dialogue nowadays, much more than the stock of NPs or the provisioning.
So, Nicola, back to you. How do you see the Greek NPL story compared to other similar markets in Europe?
Yeah, interesting question. And, I'm from Italy, and I've seen, different banks and different restructuring around Europe, not just in Italy, but also in Portugal or in Spain. And I have to say that, the Greek story is very, very interesting. And actually, if you look at the Greek NPL market, it's interesting because it went from a no-existence back in 2015 or 16 to a very established NPL market, actually one of the most dynamic NPL market right now. Well, the comparison with other European countries, I would say, yes, there are similarities, more than one similarity with Italy, but also, with Portugal or Ireland or Spain. And these countries, at some point, they face, at the same time, a very severe political crisis, economic crisis, and financial crisis. Now, in the case of Greece, maybe the recession was prolonged, and the overall restructuring took a little bit longer. Now, just to comment a little bit to the discussion we were having before, Greece lost 25% of its GDP during the crisis. And the result of this was a formation of a significant stock of NPLs. Mm-hmm. Going back to your chart before, at the peak, which was between 2016 and 2017 or something like that, the non-performing stock was reaching almost 120 billion, which was 70% of the national GDP. And, the gross NPL ratio was approaching 50%, 49 or 50%. But in certain categories, when you look at consumer or some business sector, it was even close to 60%. One of the highest NPL ratio that I have seen in history, in recent history in Europe. But what we say that Hercules was fundamental game changer for this, because we have seen some improvement in asset quality in 2018, but the drastic reduction started in 2019. And by the way, this scheme was also designed on the basis of the positive experience that we had in Italy with the GAC scheme. And just again, to comment some numbers, the reduction was 90%. So from 120 billion, we came down to 10 billion. 10 billion in 2024, which is similar to the stock of NPLs that we had in 2024, so 20 years ago. And the gross NPL fell from 49% to 7%, which is not a great number because, as we said, we are still above the European average. But again, if we look at a little bit close to the picture, especially if you look at systemic banks for large banks, we are close to many other European peers, especially in Southern Europe. But clearly there is work to be done, and we expect that banks will continue to reduce the legacy NPLs. Now, going back to the implication we were talking about before, so clearly this was dramatic a few years ago because banks reported significant loss. We know the restructuring of Greek banks. But look at the benefit right now of this NPL cleanup. Cost of risk, for example. So it was more than 400 basis points a few years ago for the major Greek banks. And now for the first time in the first half of this year, this was around 100 basis points. Again, this is still high, but it's a significant improvement. And also, what is interesting is that the formation of new NPLs has been relatively contained despite some of concern post-COVID, with the moratoria, the guarantees, and so far and so forth. So, again, looking at the future, we still believe that there is work to be done. And actually, I believe banks will take advantage of this last window, probably will be the last window for Hercules. So they will try to do more to execute transactions before the end of this year.
You have just justified why it was a task, for sure. Thank you very much. Allow me to ask to have Slido, please, on the screen. So we are encouraging you to send your questions to our distinguished guests. Harry, the floor is yours.
Thank you, Gerasimos. I think we heard a lot about NPLs and how do they affect banks, why it's important to reduce them. And we would like to deep dive a bit more on the Hellenic Asset Protection Scheme, so Hercules, because we have in our audience a lot of bank treasurers, a lot of corporate treasurers, and also other professionals. Not everyone is familiar with it. Apostolos, if you would be so kind, could you give us a brief explanation how Hercules is structured?
Sure. Let's describe how it works. First of all, you need to have a securitization of NPEs, as we said earlier on. So practically, you securitize not loans, receivables if we want to be precise, but let's say that you securitize loans. You sell those loans to an SPV, and how this acquisition from the SPV of the loans, in simple terms, is funded by a senior piece. Practically, this is provided by the bank, and from a junior piece, which is provided by the equity investor for this securitization. So this can happen because we have Hercules. Otherwise, we have a couple of securitizations without Hercules of NPEs in Europe, but it's something that the regulator is quite hesitant to do so. So unless you have the guarantee, like in Italy and with Hercules in Greece, it's difficult for a bank to fund part of the securitization. Having Hercules, practically you have the guarantee of the sovereign for the senior piece, which is provided by the bank. And of course, that makes the economic work much better because, in essence, you fund part of the transaction with your senior piece, and of course, you enjoy a coupon for this senior piece. So Hercules was instrumental in order to have NP securitizations. Otherwise, it would be close to impossible or much more expensive to do so because you had to divest a piece of the senior tranche and so on and so forth. Not to get into technical, this is the main idea. At the same time, of course, you have to pay a guarantee fee to the sovereign. It comes with a cost. The guarantee is not a free lunch. But it's worth it because if you take all the blended economics, it makes absolute sense to get a guarantee and proceed with the securitization of the NPE.
All right. So you mentioned the Greek government guarantees the senior piece. And how does the rating agencies come into play on that?
Of course, without the rating, you cannot get the SRT and the guarantee and everything. So it is a prerequisite. Maybe it's the most important prerequisite to get the guarantee.
All right. So I think, as I said, in our audience, we have bank treasurers, we have corporate treasurers. So let's start a bit why it's interesting for the bank treasurers. So Nicola, what impact has Hercules had on Greek banks? How did it help them over the years?
Yeah. So, as we said before, this was key to help this bank to return to a more normal level of NPLs. And clearly, in the past, the high stock of NPLs was a negative driver for our ratings in Greece. And also financial instability was a primary concern for our sovereign rating of Greece. But looking now, clearly it's the other way around. So the resolution of NPLs, the reduction of NPLs, the improvement that we have seen on earnings, and capital are key rating drivers for our positive rating actions on Greece. And just to give you some examples, looking at our public coverage of ratings in Greece, for instance, we upgraded by 2 notches the rating of Piraeus in 2023. The improvement in asset quality supported by improving prospects on earnings was also a key driver underpinning the investment grade rating that we assigned to National Bank of Greece and Eurobank between April and July this year. But it's also important, the improvement in financial stability, which was also a positive rating driver for our sovereign rating. And the sovereign rating for DBRS was upgraded to the investment grade level last year. And by the way, our colleagues tonight will release an update of our sovereign rating of Greece. So those are sort of the implication for our ratings. So those are the impacts on our bank's rating. And what I can say, looking ahead at the prospects of the banking sector, well, we keep so the outlook for the banking sector remains sound. And this is essentially driven by, also improving prospects for the economy, because today there were new data on GDP and they confirmed the GDP of Greece, the GDP growth was higher than 2%. And also our forecast for next year projecting a GDP above 2%. It's not an astronomical growth, we know this, but it's still a positive growth and it's much better than other European players. So this is positive. It's also true that we see some sign of slowdown across the board. We were talking about Germany before, which is the major European economy. But overall, at this point in time, the risks for the banking sector are broadly stable and contain, also looking at the capital buffers that have improved significantly and improved prospects for earnings, because our expectation is that earnings will remain resilient, even though some margin compression could be expected with the new ECB monetary policy and therefore the expected reduction in interest rates.
Thank you. Thank you. That was very insightful. And just an anecdote, last year in our summit, you mentioned that you will release the government rating today. Last year, on the same day of the summit, you had the upgrade to investment grade on the Greek government, which was a nice coincidence. I hope we have the same news today, but let's see. So I think we heard about why is it important for the bank treasurer and the cleanup of the balance sheet. Let's focus a bit on maybe on the bright side for the corporate treasurers. Vasili, I heard, I think before, that the main instrument before HAPS was to restructure clients and make a new payment profile for them. After HAPS, so for loans that are sold through HAPS, is there a win-win situation that we could see for our corporate treasurers?
I've seen quite a few cases like that. I think the main thing is one thing that Apostolos mentioned, which seemed like a benefit for the banks, and it is, but it's also a benefit for the borrowers. So this whole thing about the price or the discount rate, or if you think of a HAPS securitization or any sort of people who buy NPLs, they also have a balance sheet. On the left-hand side, you have the receivables. On the right-hand side, you have whatever sort of funding one uses. With HAPS, this funding goes down materially. I mean, when you talk to NPL investors, they'll tell you, you know what, I want a 12, 13, 15% IRR. My humble experience is that that's a very low-ball number. And then when you look at HAPS, because these are public numbers, the costs of HAPS securitizations range between 275 to 350 basis points, which is extremely, extremely low. That doesn't only give a benefit to the bank, that you discount cash flows at a better rate, but also to the borrowers, in the sense that when you have the servicer, talking to you, if his quote-unquote client, master, principal is a private equity fund, he needs to do a quick deal to get their 15%. I mean, if you discount cash flows 15% on a restructuring payment for 7, 8, 10 years. You know, it doesn't work for the corporate. So their only solution is, you know, the collateral is worth 75, give me 50 in 1 year, 2 years, 2.5 years, and go. This option is obviously available when you have a HAP securitization, but then you also have a very low cost of liabilities. So it's much easier to create payment plans that have the same present value, that end up paying the same senior. So it's a much more flexible approach for the borrower, for the treasurer of the borrower, than otherwise. And again, you don't have committees, you don't have apistia. I mean, I'm sure whoever has been in such a situation negotiating with a bank knows that. In my opinion, for good, the specialized services are much quicker in making a decision. Not necessarily a decision the borrower would like, but a decision is better than not a decision.
Thank you, Vasilis. So basically, corporate treasurers might expect a bigger discount, a steeper discount, when their loan might be sold in such a transaction.
No, it's not just a discount. No, the discount is lower. I think, to give you, I mean, I've seen a couple of examples. So, you know, you end up with a good collateral, like you have a 1, 2, 3, 5 million collateral. The fund would want you to sell it because they want their money quickly and move on. In the HAP securitization, the same servicer, because it's the same 3 people that dominate the market, is going to be much more able to do a restructuring plan and not take the collateral. Why? Because he has to pay 3%, 4% per year, and not 15%.
All right, very clear, thank you. And Apostolos, maybe a very similar question. So what would corporate treasurers expect, like in general? Not just in terms of restructuring, but having their loans sold in such a case?
I think it was mentioned by Vasilis, and it's not only for corporate loans that are sold to an investor or to a servicer, but it goes for the retail clients also, if I can say so, because it's not always negative. And why is that? First of all, it was mentioned earlier on that banks are not that familiar with restructuring and being flexible, especially in the old days. Now we are much more mature, we have done our homework, but it's not our core. So it's not that bad for a loan to be with an investor at the end of the day, because the investor has more flexibility, less bureaucracy, and more willingness to restructure and to restructure fast. We had chances in the Greek reality that corporates that they had issues during the crisis, they had loans with all systemic banks, very hard to restructure, you know, all banks to sit on the table, around the table and find a solution. So loans were sold to an investor, and practically the corporate had to deal with one. Maybe it was a difficult discussion, but you had to deal with one. So at the end of the day, it was much better than dealing with 4 banks forever. So it depends on the case, of course, but I would say that for a corporate that has issues and eventually the loan is sold to an investor, it's not always bad. It might be helpful.
All right, thank you. And just before I go to my next question, I think during the break I heard a nice story that between the 3 of you, we had the first transaction also in Hercules. So Apostolos was heading the department that executed the transaction.
Vasilis was the mastermind. We were the clients. DBRS helped a lot, of course.
Vasilis was the financial advisor, and DBRS rated the senior note. So it's definitely pioneering work.
But it was definitely the Eurobank running the numbers. So.
But looking at the past, let's look at the future. Vasilis, do you see more of these transactions going forward?
Yeah, definitely. I mean, it's well known to everybody. There is another 2 billion scheme out there. You know, there are rumors that it might be topped up to maybe a 3rd billion. So somewhere between 2 and 3 billion of guarantees are waiting to be deployed. I think one non-systemic bank has been very vocal about it in the media that they're going to use it. It's very good for them, and you know, it's a very good way to to break the deadlock. So again, what I think is Q4, maybe Q1, definitely, maybe a few will lapse into Q2, but there's another 6 to 9 months that DBRS will be pretty busy on new origination.
So Nicola, why do you think you will be so busy? What are the costs of unresolved NPLs in banks?
As you said, clearly we have seen in the press also discussions about the possibility to increase the ceiling to 3 billion, and this will clearly help more banks, small banks, large banks to complete a number of transactions by the end of the year, assuming that the end of this year will be the expiry date for Hercules. So we'll see.
All right. So we do see financial and operational costs in banks with NPLs, which will need to be solved.
Yeah. Well, what we were discussing before, we were talking about the improvement that we have seen in the banking sector through the resolution of NPLs, and part of this was clearly achieved inorganically using the securitization scheme. But the full picture of NPL resolution remains unfinished, right? So now we welcome what we discussed before, the improvements that were made by the banks, the creation of a broader and deeper NPL market, a very active servicing market. But we also welcome a number of new legislation reforms, and some of them are still ongoing, therefore we haven't seen the full benefits. But overall, we believe that a more efficient judicial system in Greece will help the country to close, especially when it comes to investment, the gap with other European players. And I think Greece is also a great opportunity when it comes to the deployment of the European funds. Again, talking about the unresolved story of the NPLs, what we know, if we look at data the year-end last year, so we know that credit services are managing more or less 70 billion of debt. We know that this debt was offloaded from banks' balance sheet thanks to the securitizations, but we also know that part of this debt is still there, so it didn't disappear and is still within the economy. And this is an important aspect. The fact that it stays there means that workout procedures are not proceeding the way they should be. And this has to do with the legal system and the obstacles in the legal system. And this is a risk for the companies that are running this debt, because we have seen a transfer of risk from banks to non-bank FI. It's also theoretically a risk for the government, because here we are talking about contingency liabilities. So the government has supported the senior note for around 19 billion or something like this for a number of 17 transactions. So this is a risk. But finally, the risk is also for banks, because I think the Greek banks have done a great job when it comes also to corporate loans, origination of corporate loans. And part of this was also channeling the European funds. But I think they are still behind when it comes to loans to households. And part of this is due to the still NPL unresolved story. So again, quick comments on the judicial system, looking at the most recent data, for example, the development of auctions. We have seen still a high share of auctions that have been suspended for procedural reasons or technical reasons, or auctions that essentially failed because of lack of interest. And the lack of interest sometimes is due to lack of information, basic information on the property with a part of the auction process, or lack of documents. But there have been also delays in the post-resolution, post-auctions, or just in the registration of the transaction within the property register. So those are things that could become more efficient, and therefore they would help the economy as well. Because As we said before, I think the households, corporates, the whole economy needs a stronger banking sector which is in shape in terms of capital and liquidity, but also banks will need to be in the position to lend money to the economy. And the other point, which is, in my view, important, is the topic of reperforming loan. This could be an interesting development going forward. And also in general for banks, they are thinking about the post Hercules environment, because at some point this scheme will expire and therefore banks will need to resolve legacy NPLs without the scheme. And this is important for resolution of NPLs, but also to prevent future formation of NPLs.
Great. Thank you, Nicola. So I think we were very efficient. We still have some time left to take some questions. The first question I see on the board was very similar to my closing question, so I will start with that. I think that's a very good spot on. So is it a lesson learned? What risk management measures have we put in place for future growth of NPLs as banks? I will tell you can take the question as you please, whoever wants to answer that.
I can give it a go and see what happens. Risk management measures in place. I think the dialogue has changed a bit. I mean, I've been working, with another bank in the good old glory days. I'm now working for Alpha these days. The process is very similar. I think, there's still committees in banks underwriting risk. There is much more scrutiny, as I mentioned, from the regulators, which is good and pushes the banks to monitor much more closely the gray situations. But I think the one thing I noticed so far, which is materially changes, is the fact that all the credit, the underwriting, currently all then much of the underwriting decisions take place around cash flow available for debt service, so cash flow. So I think that's very relevant for corporates. A lot is around on leverage, a lot of discussion in committees is around leverage ratio, cash flow available to service the debt. Back in the old glory days, a lot was around, XYZ, he has a great contract with company Diageo, so he will be able to pay the debt. So a lot was around the collateral. So a lot of discussion has moved from the collateral-based discussion, collateral-based lending to cash flows. And the second thing very relevant also with corporates is name lending. I mean, it's a fact we've done name lending back in the old days. Some of these cases haven't turned out to be well, so there's no sacred cows. You talk about, I don't want to start throwing names here, but the very big names, and say, Mr. XYZ will never default. Sure, we were saying the same thing about Mr. Y 10 years ago, and it did default. So I think that's the two key things from the bank side. So very, very cautious on name lending, much more focus on cash flows, at least on corporates, and a lot of more scrutiny from the regulator.
All right, thank you. And if I may add the follow-up, maybe for Apostolos, for you, this new prudence, did it affect the credit expansion going forward?
Definitely. More hard underwriting, has its implications, but I think it's the proper thing to do. So as Vasilis said, more proper underwriting nowadays, which makes absolute sense. And of course, if I can add something, you have to be very careful in terms of not the change of the underwriting of the new loans that you give as a bank, but also with early warning systems to prevent the new formation. So you have to work on both things. But going back to your question, of course, more hard underwriting to some extent affects the new production.
I see a question for Nicola. So, what are the most common risks associated with NPL securitizations that could lead to a rating downgrade, and how can they be mitigated?
Well, I'm not a securitization guy, but I'll try to answer the question. I think what we said at the beginning, so we take into account a number of factors, clearly, the composition of the portfolio, the breakdown, the granularity, and what is really important also is the business plan, so the expectation in terms of cash flow. Relevant is also the analysis of the operating environment, which is, real estate. I think is an important component because we are talking about asset, there is collateral there. And also the legal framework, the judicial system, and the tools that banks and services have at disposal to work out this position. So I would say that a significant deterioration in economic conditions or a significant deterioration in real estate could be a negative rating driver for these transactions.
Thank you. One extra question or not? You have the time?
Yeah, maybe let's do closing remarks. That should be on time. So 30 seconds each. What do you see for the future in the Greek banking system and also expansion in credits for corporates?
I think it's a new era for the Greek banking system. The NPE issues is almost done. We said that, we have some distance to cover for the European average, but more or less after Hercules 3 especially, we will be at a level for a southeastern country which is fully acceptable in my view. So this is done, and now we have to be more cautious with, as we said, the new production. And of course, we have to see how the economy will evolve, because one of the main issues that we face is the limited growth in terms of credit expansion. So we have to see how it will go there, especially on the retail front, because most of the growth is coming from the corporate, obviously for all banks. This is something that we have to see how we will create again the retail market. So we have to be quite careful. And also, there is a question also there, how you diversify your income. As we know, the flavor of the month is commissions and fees across Europe. So we have to see how we will further expand banking in order to create more fees and commission as a source of income. So all in all, quite positive, especially the performance on the Greek banking system vis-à-vis the other European banks in terms of NIM margin and so on and so forth is quite beneficial. But we still have to work a lot in terms of creating new business.
Thank you. Good. You certainly agree.
Recovered.
And Nicola?
Yeah, I absolutely agree with what you said. And the work on the legacy NPL is nearly there. So I think that the challenge is to expand, on one hand, the new origination under new criteria, different compared to what we had in the past. And then I think the other element is innovation and diversification.
Thank you.
Thank you very much.
Thanks.
Very insightful. Thank you.
Thank you.
Thank you.